Good morning and welcome to today's 5 with Fitz. I'm Keith Fitz-Gerald and I'm wearing a sweatshirt because it feels like, you know what? There's a little bit of fall in the air up here in the Pacific Northwest. Anyway, on to the markets. Just like that, and just like I said was probably going to be the case, the major averages are up and early going after Friday's shellacking. I made the suggestion that you should be buying into that, and I hope you did. Now, the question on many people's minds is, can it continue? And the answer is very definitely, yep, maybe. This is still a still market, as I noted in last evening's short. Now, what do I mean by that? Watch this short because people still don't get what's happening. Now, to be clear, I do expect some volatility as earnings season tails off in the weeks ahead, but that too is entirely normal and critically a sign that the markets are working normally. Remember, doggone it, investing doesn't have to be complicated, even though most investors mistakenly believe it does. You've simply got to be in to win or you won't win. Simple as that. Anyway, here's my playbook today. Number one, Palantir. I can't possibly own enough shares. The Venerable Stuart Varney asked me about today. He asked me today. I rented lips today also. It's Monday. Stuart Varney asked me ahead of today's opening bell about two names that I'm watching very closely this week, Palantir and IonQ. Now, both of them report earnings. He very kindly remembered that I've been on Palantir since it was trading under $10 when he asked me to make my case that it's going to 200. In fact, and if memory serves, I was the very first guest to mention it on his show long before Wall Street could even spell the company's name. Palo, what? I got on a number of occasions from colleagues and many investors around the world for that matter. Anyway, that's changed. But also, IonQ is a similar story. I think it is not only just a quantum computing company, but the best quantum computing of all of them. I expect IonQ to grow 3 to 5x within the next few years. And you don't just see that kind of potential very often. It's Palantir-like potential, and it's doubly important to latch on when you do. Speaking of which, let's talk about Palantir for a second. Team Carp, number 2 today. Team Carp reports later today as I record this, and I say, hoo-yah! I wouldn't be surprised in the slightest if Palantir puts up its first billion-dollar quarter. Now, speaking of which, is it too late to buy Palantir? Not even close, and for all the reasons we talk about regularly. Wall Street is still peddling the same tired fairy tales. Valuation, earnings justification, growth premium, yada, 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 yada. Flip that around. I've been doing this a long time, and I've learned over the years that it's almost always more profitable to take the other side when everybody knows something, right? And this is no different. Don't ask why you should buy. Ask yourself why you wouldn't. Not shouldn't, wouldn't. Can you make the case that whatever company you're talking about, in this case Palantir, is a dog? That growth is slowing, that management is failing, that customers hate its products, that it's diminishing relevance in the marketplace? Didn't think so. I can't make the case either. So Keith's investing tip in this department, the markets reward knowledge, not guesswork. So if you've got this sorted and you're getting the results you want, outstanding. If not, and you'd like help building the next Palantir or finding the next Palantir with your portfolio, I'll be here if you need me. It's a short list, by the way, and the OBA family, by the way, has a great head start. So anyway, number 3 today, Tesla's $29 billion big bet on Musk, the man himself. Tesla's just approved a new $29 billion stock grant for Uncle Elon, right? About time, in my humble opinion. Here's what matters. The 96 million restricted shares are part of a new interim reward that is meant to replace the 2018 compensation package that was voided last year by a Delaware judge for being unfair to shareholders. And my reaction was like, really? But it carried in court. Now, that old award, valued at over $50 billion and the source of a multi-year legal soap opera that's been hanging over Tesla like a bad reviewer whose niece didn't get the lead. But Musk is appealing, and in the meantime, the board took matters into their own hands. That's what you want to focus on. And shareholders will likely be far better for it. Now, be fair. Musk doesn't get the shares for free, so don't make the mistake of thinking he's just handed these things, right? Musk must pay $23.34 a share, the same price as the 2018 comp plan, to get his mitts on them. Now, what's more, the award is structured to boost his voting power over time, effectively dictating / requiring that he's got to earn the right to greater control. something Musk himself has said is critical to keeping his focus on Tesla's future, especially as robotics roadmap accelerates. Now, I agree 100%. Retaining him removes a big overhang and reintroduces clarity, which in turn inevitably brings innovation, revenue, and, yep, more profit potential over time. That's important to investors, don't you think? Anyway, my POV is you don't hand somebody 96 million shares unless you believe the company's about to enter an entirely different league. The board clearly does. Me too. Number 4, Boeing can't catch a break or evidently fix one either. Roughly 3,200 unionized Boeing defense workers have just walked off the job after rejecting a new contract that included a 20% wage hike and a $5,000 bonus. I mean, anyway, this strike targets fighter jet operations in St. Louis, and while there's no immediate impact on commercial aircraft, the defense delays, particularly on programs like the F-18 Super Hornet, could ripple through military timelines. Now, Boeing or not, let's not kid ourselves, folks. This is not an isolated headline. It is the latest flare in what's becoming a long string of labor unrest across industries in 2025. And for Boeing, frankly, it's just another log on an already raging fire. I mean, yeah, the company recently posted its best delivery numbers since 2018, and yeah, the market cheered. But as I told you when that happened, I am not buying the comeback narrative, literally or figuratively. This is the same company that is still tangled in FAA restrictions, delayed certifications, and an internal culture its own CEO admits lost its way. Then there's an added $1.1 billion crash settlement, a deadly 787 incident, the Qatar mega order that feels more like diplomacy than durability, and the cracks start showing up, right? I mean, yeah, this stock has rallied nearly 60% off April's lows, and yes, I've publicly kicked myself for not jumping in around 128 bucks a share when the setup looked tempting. But investing just isn't about bounce plays, right? It's about trust. And Boeing still has a long way to go to earn mine back. Now, I'm frankly wondering this morning which windshield this bug hits next. My POV on this is that labor strikes are rarely about the money. They're about culture, leadership, and values. And if Boeing wants to win back the investors and workers alike, it's going to have to prove that it can build more than just planes. It's got to rebuild its credibility and trust, starting with the people who open its doors every single morning. As for strategy, well, here's a trade idea. If you're tempted, and you might be, and I get it, I think long-dated leaps calls remain the smartest risk-contained way to play this. And I mentioned them a while back, and they've done very well if you happen to have gotten on board. If you believe the turnaround is going to take hold, I personally am leaning towards push, short, and avoid until the company shows real lift, not just the headlines. Remember, there is always a difference between recovery and reinvention. And finally, number 5 today. I know this is financial heresy, or about to be anyway, but I think Berkshire Hathaway, as in Uncle Warren's Berkshire Hathaway, could be in far deeper trouble than meets the eye, and shareholders had best pay attention to what's happening. Here's my thinking. Number 1, earnings are soft. Q2 operating income fell 4% year over year to 11.16 billion, I think, mostly dragged down by insurance underwriting. Railroads, energy, and retail were fine, but not enough to offset the hit. That's critical. The core business is just coasting. I want growth. This is just coasting. Number 2, they're still selling, not buying. I mean, Berkshire has dumped $4.5 billion in equities in H1 2025, the 11th straight quarter of net selling. Now, even with a 10% dip in their own shares, no buybacks. Now, that's interesting to me because Berkshire's always been big on buybacks. So, translation here is either they're not seeing value or they simply don't know what to buy because Berkshire's lost its way. Number 3, the cash mountain continues to grow. $344.1 billion and counting. That's not just dry powder anymore. It's dead weight. Buffett obviously has legendary patience, but that's, something that raises a lot of questions. This kind of inaction is about vision, at least in my mind. Number 4, Kraft Heinz is back in the penalty box. There's a fresh $3.8 billion write-down. 2 board seats were lost. Spin-off chatter is swirling. Even Buffett has admitted he overpaid. And finally, this is really the big one. Abel's in the wings. Abel's in the wings. Greg Abel officially takes the reins in 2026, right? Abel, I think it's Abel. Anyway, right now, no bold moves, no new strategy, and that's the rub. Berkshire's biggest wins in recent years, like Apple, came from taking very calculated swings. And without that, it's just ballast, not rocket fuel. Now, to be clear, Buffett is a titan. He has changed how generations think about investing, including me. But you can't play catch with someone who isn't there. Unless Abel picks it up quickly with fresh direction, conviction, and tech-savvy firepower, I think there's a good case that Berkshire risks becoming a study in how legacy becomes a lack of inertia. Anyway, that would simply be terrible to see on a lot of different levels. So today's bottom line, as always, very importantly, investing is about focus, not noise. So plan, execute, and repeat. That's it. You got this, I promise. As always, let's make it a great day. Start the week strong. Get on to earnings. Rock and roll. You got this. Thanks for joining me. See you tomorrow.